Hi, Paul Gerard from Price Accounting Services, back talking in our series today about structures, and specifically in this episode we're going to discuss discretionary trusts. Sometimes you hear of them just called family trusts, which is not quite the correct term, but we'll explain a little bit about that in this series. Okay, so what's a discretionary trust? Okay, a discretionary trust has a trustee. It's the legal entity or legal person who maintains and manages the trust. And it might be a company, or it might be an individual or individuals. We don't typically recommend individuals act as a trustee, but there can be situations where it might, given legal advice, make sense. The trustee will own any trust property. So for example, if it owns, let's say, land and buildings, the registration of title will be in the name of the trustee. However, typically a trustee will sign for documents as ABC Proprietary Limited as trustee for the trust, whatever the name of the trust is. And that's on record to show that ABC Proprietary Limited doesn't actually own the property itself, it owns it on trust. So it's important, first of all, that you're going to have a trust deed, and the trust deed is going to be established by a solicitor and settled, etc. And we're going to talk about the parties to that process next. So, you're thinking about a discretionary trust and you want to set it up. So the common process is a trust deed needs to be formulated, which creates that legal obligation between the parties. Who are the parties? You have the trustee, you have the settlor, you have the appointor, and you have the beneficiaries. And you'll also have trust property. So they're going to be your elements of your trust. So let's go through who each of those are. We've already discussed who the trustee is. That's going to be the entity appointed to manage the trust, okay? So it might be a company or it might be individuals. The other key party to the trust will be the settlor. Now the settlor is the person who initially gives property to the trust to hold. And the common wording for most discretionary trust deeds will be along the lines of the settlor, i.e. Peter Perfect, gives to the trustee a sum of, it might be $10, $100, $200, some token property, and the trustee agrees to hold it on behalf of Peter Perfect for the beneficiaries named in the deed on the terms of the trust, and the trust deed will outline what those terms are. And commonly for a discretionary trust it will be to hold it for an extensive period of time or until the trustee decides to end the trust, which is called vesting. And sometimes a rule of perpetuities can limit that time period to 80 years, and that's an issue which will require legal advice at the time you set up your trust. So when the trust is established by the appointor, and typically the settlor, the settlor will commonly be some party who's not likely to be a beneficiary. And I would generally suggest somebody who holds no interest in the trust. It could be a solicitor, it could be a very close friend who you don't expect to be a beneficiary of the trust, etc. And so they will give the trustee, ABC Proprietary Limited for example, $20, hold it on trust, etc. The trustee will then execute the trust deed together with others, and so then you have a trust deed. But the key party to all of this is what we call the beneficiaries. And the beneficiaries are generally named in the deed because the deed needs to specify to whom the trust property will eventually be given. The most common form of discretionary trust is one which is a cascading relationship. So for example, it might say the beneficiaries are the persons named in the schedule to the deed, and it might be mum and dad, okay, myself and my wife, or it could be my parents. So that relationship then has a cascading relationship effect. If you read the trust deed, it will commonly, but not always, say the beneficiaries shall be the persons named in the schedule to the deed, and then it will proceed with and their children, their parents, their adopted children, and so forth. And then it will go on further and perhaps say, and any trust with which I'm a beneficiary or a trustee, and it may vary, and so forth, and it'll expand itself out to companies, etc. And then there's often a provider that says, and any relative of the persons named in the schedule. So you end up with this family tree that's drawn in as, we're not suggesting they are beneficiaries, okay? Potential beneficiaries of that deed, okay? So my unborn children are potential beneficiaries, despite me not knowing if they are going to be born or their names, okay? So their rights and entitlements under the trust might become established later through two things. One, becoming born and becoming a human, and secondly, the trustee giving to them a share or a right or entitlement to any trust property, either income or assets. So that's the general gist of how a discretionary trust is established. So what are the features of a discretionary trust? Okay, a discretionary trust will determine its income for the year. So let's say it could be a rental property. It will receive its rental income and it'll have its rental expenses. And there'll be net income. So it's what's left after the accounting process has been completed. The trustee will call for the trustee to make a choice. The trustee can either choose not to distribute and the income is retained in the trust, in which case the Tax Act provides the maximum marginal tax rate applies to the income of the trust. Okay? Most people choose not to do that for obvious reasons. The second option for a trustee is to determine and resolve prior to the 30th of June, in compliance with the Tax Act, to distribute that amount of net income in a manner that it sees fit. And that's where we get this term discretionary trust, because it's at the trustee's discretion how that occurs. Now remember, Mum and Dad may well be beneficiaries and also the two directors of the trustee company. So they may turn around and say, right, we're going to make it 70% to Dad because he's got an investment property already and he's got some income, and we're going to 30%, etc. So that's where this discretion occurs. It's not as simple as that. There needs to be resolutions. They need to be done before 30th of June, and it needs some tax guidance, okay? You get that wrong, the tax office will determine that there was no valid resolution made and impose that top marginal tax rate. So it's an important consideration to get right, and using an advisor who knows what they're doing with trusts, okay? So as tax advisors, we have a lot of experience in dealing with resolutions and distributions, and even this thing called a family trust election. This is where we get this name, it's a family trust. So, a family trust election may be needed in some situations. For example, the trust might have a large amount of accumulated investment income, such as dividends, and it might have franking credits. The Tax Act provides that in certain situations, in order to pass that tax credit through to the beneficiary, the trust must have made a family trust election, which is irrevocable. And the family trust election is a fairly simple, but at the time of making it, a complex process, because you need to nominate a test individual. And so we might nominate Dad as that test individual. And so we can't then later on bring in Dad's mate as a beneficiary of that trust, because he doesn't meet that definition of a family trust. He's not a bloodline relation of Dad. So that's an important consideration in terms of limiting features of a discretionary trust. Unlike, say, a unit trust where you can bring in third parties, you can't do that with a discretionary trust. But there may be other forms of trust structure or other structures which can do that, and we may talk about them later in the other trust structures video. So have a look at that, where we might discuss things like a class discretionary trust or a hybrid trust. So we'll come back to that. So I hope that's been helpful in addressing just some general features of discretionary trust. We get a lot of questions about discretionary trusts, and in many cases, particularly where there's property, we also need to give a degree of caution. It's not straightforward, okay? People often say, what are all the things I need to consider? Well, if I was to ask a lawyer that question, I reckon they could probably rattle off about 50 things, okay? And as a tax person, I could probably name about 10. So it's really important to get the tax advice and the legal advice, and to make sure your trust is established correctly. When you establish your trust, the things that may impact it will include land tax. For example, in New South Wales, a discretionary trust gets no land tax threshold if it owns property. However, if you've already blown your thresholds, then it may not be a concern. It's an alternative structure that might give a degree of flexibility if there's positive income. However, if there's negative income, such as negative gearing, a discretionary trust can make a lousy investment vehicle because the losses stay in the trust. A trustee cannot distribute losses, so there needs to be something else to soak up those losses. And if it only owns the one property, then that might be problematic. So loads of issues to be explored when you're considering a trust. We welcome discussions about trusts and more than happy to discuss in general terms, but we always recommend you then seek legal advice. We would probably, for every 10 inquiries, 9 would probably be people who are thinking a trust sounds like a great idea, but in fact it probably makes a poor choice because of extra costs, negative gearing and a whole host of other factors. But everybody's different, so give us a call if you're not sure. Happy to guide you and give you some basic preliminary guidance prior to you then getting tax and legal advice to a more defined level. So I hope that's helped. Watch our other videos and we look forward to seeing you soon. And until then, bye.